Welcome. I'm Ebony Gilbert, Market Strategist at Vanguard Australia. Today I am joined by two of Vanguard's investment experts who will provide an overview of our economic and market outlook for 2018 and beyond. Aidan Gayson is Senior Investment Strategist and Matthew Tofano is an economist, both within our investment strategy group. Today they will help us interpret how investment and economic trends may affect client portfolios. Welcome, Aidan and Matthew.
Thank you.
Thank you.
So let's get started. Before we look forward, it's important to recap. Aidan, did 2017 pan out the way we thought it would?
Absolutely, and I think it is really important to go and look back, as humbling as it can be, as to what we did say for 2017 and how we saw that playing out. And the theme of our 2017 outlook was stabilisation and not stagnation. And so we thought global growth was going to stabilise sort of around those trend levels, and we weren't going to see the kind of stagnation scenario that a lot in the market were talking about. Other aspects of that outlook really centred around, tightening labour markets, which would likely result in a modest pickup in inflation. And then moving to our expectations or the forecast that we had for Australia for 2017. And for Australia, we actually felt that Australia was entering a more vulnerable period for global growth. On the one hand, we had sort of some tailwinds from a construction boom that we saw fading, and that was really balanced by headwinds from the mining boom that were also fading. And so that was leaving Australia in a bit more of a vulnerable period for growth. And as those two forces unwound, we thought GDP would likely settle at somewhere below trend. And as GDP printed throughout the 2017 year, we really saw that come in at around that 2 to 2.5% range over the year.
And so now, after all the number crunching that's been done, what is the forecast looking like for 2018?
So for 2018, we expect continued improvement in global growth, with really just a few exceptions. And I mean, one of the risks from this scenario is that, we are seeing labour markets continue to tighten, and we think that will result in further pickup in inflation, really led by the US, where you're now seeing employment levels, coming down to that 4% range. And whilst we see that inflationary pressures longer term is going to be anchored by those longer term forces, that we were talking about in 2017, being technology, globalisation and demographics, there is some risk that if we get a shorter term pickup in inflation due to these tight labour markets, that could actually take some investors by surprise. And that's one of the key risks that we see playing out in the forecast globally for 2018.
Thanks, Aidan. It'll be really interesting to hear how that impacts client portfolios. Matthew, could you talk to us a little bit about our outlook for the equity markets?
Yeah, I'd be happy to. Our outlook for the equity market is a little bit lower than what we've said historically. Our 10-year expected return, our central tendencies, 4.5% to 6.5% for global equities. Now that reflects higher valuations than what we've seen in most of the developed economies that we follow. Low inflation and low interest rates kind of all conspiring to make the environment still possible to achieve equity returns of a decent amount. But just given kind of the high air we're flying in, there's not a lot more headroom above us.
What about bonds? What can we expect to see out of the fixed income market?
Yeah, well, bonds are a little bit easier to forecast than equities for a variety of reasons, but particularly because we can look at the initial interest rate that bonds have on offer right now, and that gives us a good idea of where we're going to end up in the future if we hold those bonds to maturity. So our 10-year annualized forecast for bonds is in the 2 to 4% range is the central tendency of our outcomes. And that mostly reflects low interest rates and low inflation, but also that yield curves are pricing in some central bank policy increases over the next few years, and that we do see that the coupon that you're earning as yields do increase, that coupon will be reinvested at a higher rate, and that's how you get that higher total return approaching 4%.
And so probably a burning question for many, how do we see central banks responding to economic and market developments?
Central banks responding in 2018 is going to be kind of the key decision point for a lot of market participants. And we think it really is going to be a function of how inflation evolves. You'll see on the screen we have historical inflation in the United States, something that we think the Fed is watching very keenly. And in our mind, there's room for inflation to pick up a little bit. However, we think is that if the market sees inflation on the rise, that they may price in more moves by the Fed than maybe the Fed has planned. And we could actually see inflation come back down to reflect the longer-term trends of technology, demographics, and globalization, as we've been outlining earlier.
Thanks, Matthew. And so, Aidan, turning our attention a little bit closer to home, what is our outlook for Australia?
Well, for Australia, our expectations are actually more muted than the expectations that we painted earlier in terms of our global growth outlook. So I think Australia is one of those exceptions. We've just come off a period where we've had a mining boom that really drove growth for the economy. Just as those effects of the mining boom were fading, we then had the construction boom, and that sort of came in and drove growth. When we think about the outlook for Australia now, it's very hard to see what that next growth driver is that's waiting in the wings. Add to that some of the sort of local market conditions, in particular the leverage within the household sector. If you compare that to much of the developed world, most economies in the developed world had a pretty destabilising experience in the financial crisis, and that really sort of pushed investors and households in particular to delever their balance sheet. We haven't seen that happen here, and in fact leverage has only increased. And so with high household leverage, pretty benign wage growth and credit conditions tightening, we actually think growth in Australia is likely to come under more pressure and come in at that sort of sub-trend level relative to what we've seen in the past.
So with all those challenges facing Australia, Matthew, can you talk us through how you think the Reserve Bank might respond?
Yeah, they're in a predicament, and this probably frames our idea that the Reserve Bank faces a dilemma for what to do with interest rates in 2018. Because on the one hand, you've seen household leverage build up, you've seen spectacular price appreciation in the property sector, and you've also seen credit growth continue at a pretty robust pace. So you would think that the RBA would be keen on raising interest rates potentially to kind of combat that stability side. But on the other hand, we have inflation that's been somewhat low, and wage growth has been a little bit steady, if lackluster would be a generous term to describe it. So they really face this environment of, well, there's not a good clear-cut solution to either problem. You can make equally strong cases to raise interest rates or cut interest rates. So we think in their minds they're solving this by buying a little bit more time through 2018. We wouldn't expect to see any kind of action until at least the second half. We think they're going to drag their feet a little bit and hope economic conditions improve.
Before we talk about the implications to client portfolios, it's really important to touch on China. And it was quite a significant year with the 19th National Party Congress being held in Beijing in October. Can you touch on how the Chinese political environment has impacted our economic outlook?
Yeah, Ebony, in some ways the political outlook has reinforced our view that China's growth is going to be healthy and potentially more stable over the next few years. Xi coming in and consolidating his power at the Congress is a good sign, especially if depending on how much progress he makes on the reforms that he's been talking about over the past few years. So we think that's going to be the primary driver of economic growth and policy over the next, at least through 2018. And the challenge is going to be how fast they press on that agenda, because they're keen on making reforms but not doing it too much to compromise economic stability in the short run. So you may see kind of a give and a take, or as we've called out before, a fight and retreat mode. They'll make a reform, and if it's potentially a little bit too jarring for the economy as it's rebalancing towards service and consumption, then maybe they'll pull back or they'll implement another tool over here to kind of offset that. But we're optimistic. We don't think that there's much risk of a hard landing, and that's because at least on the raw materials and production side, China's pretty close to its 2020 goals when you look at its production caps and targets for raw materials like coal and steel.
So in bringing this all together and thinking about the implications for investors, How should some of our listeners be thinking about investment portfolios, particularly in a market where we're seeing, an increase in risk in the market and some downward trends potentially from returns? Yeah. Aidan, maybe we could start with you.
Sure. And the first thing that we would caution against, and I think what's really important to remember, is that investment markets often depart from the performance of the economy. So actually trying to reposition your investment portfolio based on a forecast or a view that you've heard against the global economy is often not the right approach. And it's actually similarly challenging to try and time markets and actually predict what investment markets are going to do and adjust your portfolio. A far more prudent approach from our perspective, particularly given that backdrop of compressed returns, is that investors, potentially should be adjusting back their return expectations a bit, as opposed to actually repositioning the portfolio on the outlook that they hear, whether from us or others that are out there in the market. And it is the time of year for it.
And Matthew, be interested in your thoughts.
Yeah, I'd say the one thing I'd have to add to that is to be realistic with what could happen, and let's revisit our portfolios. And now more than ever is a time to be disciplined. If we're going to make changes to the asset allocation, it should be driven more by changes in our plan or our life circumstances than by the whim and fancy of the financial markets. Because in the short run, it tends to be kind of like a voting machine, and in the long run is where you see that weighing machine that Benjamin Graham has spoken about. So now more than ever is a time to focus on whether we have a desired versus required return target baked in our minds, and make sure we're investing and saving as well to reach the goals that we've set for ourselves.
Well, that's it for today. Thank you, Aidan and Matthew, for your insights. I'd also like to thank everyone watching for taking the time to join us. If you'd like a deeper dive into any of the topics we've raised today, please take a look at our 2018 Global Investment and Economic Outlook paper, or contact your business development representative. Enjoy the rest of your week, and thanks again for your time.